Good evening, Oak Bloke here, and we are going to talk about the next idea for the picks for 26, and it's going to be this. So this is called Amova Cash Rich Japan Equity. So it's a fund. So this is the first fund that's going into the picks for 26, and these are the ideas so far. So I'm not going to go back over them because they're covered in other videos, but this one's joining the party. As you can see here, it's an accumulating fund, so it doesn't pay a dividend, but it is all about getting dividends. In other words, we're going back to Japan for this idea. Back to Japan because in 2025, in the Oak Bloke 25 there was the Bailey Gifford Smaller Japanese. So I thought, what can I do this year to top that one? Because I do like that one and I still hold that one and it's done very well for me. So I particularly liked the idea that there's reforms going on in Japan. I mean, we'll talk about these, but what was the best way to take advantage of those trends in Japan? So I guess it's a nod to Japan or a bow, and there are different types of bow, as you can see here. This article will be released. This is on my Substack, theoakbloke.substack.com. So this article will be released in the next couple of days, but you get to watch it first. And yeah, so a Mova Cash Rich Fund is all about finding the companies that are hoarding cash, that essentially their current assets are greater than their current liabilities and their long-term liabilities. In other words, they're what's known as a net net. So, I mean, you could basically buy the company, grab all the cash out of it, and you'd have more money than you started with, which is a bit insane, isn't it? And then you've got a free business on top. But that's actually sometimes the case, that the assets are so large in these businesses. They've got so much cash on their balance sheets that they're just hoarding it because that's kind of almost psychologically what they've wanted to do or felt they needed to do. Um, since 1989. So, I mean, some of these companies have been hoarding for decades, and what's changing, what's happening now is that it's the case that the Japanese stock market is encouraging companies to better consider shareholders, to pay dividends, to start buybacks of shares, um, and to be more shareholder friendly. So this particular fund is quite new to the market. It's 1 year old. It's achieved quite a strong result in that first year, 21% return. As you can see, it's predominantly industrials, consumer cyclical, technology, basic materials, and these are its top 10 companies. So you can see it's 1.9 down to 1.4. So there's quite a large number of companies in this fund uh, that cover different scenarios, and but the commonality between these is that they are all cash rich. Okay, this kind of gives you a slightly different view of it. So it's auto parts and equipment, 22% of the fund, building materials, 13%, electronic, 12%, chemicals, 11%, and so on. So these were just two different ways I saw that the fund gets broken down. So this is all about um, companies that are cheap. So this is very much a value play, not sort of bright shiny stuff. Um, the companies in question. So I'll just put this up on screen, where you can see here the valuation. And these are the top 10. So the top 10 are on price earnings averaging 14 times. So they're on very low. That's the historical price earnings. That's the forward price earnings. Forward price earnings of 13 times. You can see here price earnings growth. Some of them are below 1 times, but as you can see, I mean, they're on average 1.04 times. So what that means is the price, so the earnings are growing pretty much the set, sort of at or around the price earnings number. So that you can sort of see there's some really good levels of growth. I mean, not spectacular, but these are companies that not, this isn't sort of, this is value, this is not growth, but that number is actually quite impressive considering they're not growth, if you follow me. um, they're all generating lots of cash, so they're very highly cash generative. That is how much cash they've got on their balance sheet. So basically, if you take the current, when I say cash, I'm talking current assets minus all liabilities. So for example, this first one, Kumagai, which is a construction business, has got £2.5 million more assets than it has total liabilities. So on a 221 million market cap in British pounds, and it's at 1.4 times its book value. And again, you can sort of see here, price to book. Some of these are actually trading below 1 times their book value. So this industrial machinery is an example of that. So very, very impressive numbers, I think, and as you see as well, return on equity of about 10%. Debt to equity quite low, as you'd expect with a cash rich company. It'd be a bit strange if they did have vast amounts of debt. You'd sort of have to try and work that one out, and you can sort of see enterprise value to earnings again, sort of at about 9 times, so cheap, in other words. And you can see there's a very big range of 90 million through to 27 billion. So there's a whole range of companies that come under this. So so yeah, it's kind of like what I suppose what Buffett does. So not that I'm pretending to be as good as Buffett, but in my own little small way, if I can be a little bit like Buffett, well, hey, I'm not gonna, uh, uh, um, I'm not gonna sort of uh, be unpleased with that description. So yes, you could look at them as boring, but you can also look at them as exciting in the sense that they are, um, you're buying them cheap, you're buying them where the shareholder returns can increase, and you can sort of see this is a really good graph from the guys at Amova, and what they say is that in Japan in particular, I mean, you can sort of see here, compare that to sort of US equities or global equities, the ability to outperform benchmarks in Japan is particularly good because there's very little coverage of these companies, and some of them have no coverage. And there's a lot of companies in Japan, 4,000 companies, so nearly as many as the US, even though the population is well less than half. Um, so as I say, it delivered a 21% last year. As you can see, it went down in the Trump tariff tantrum thing there. So it dropped to a loss of 10% at its low point. So since that low point, if you bought there, you would have made 33% actually if you'd picked them up at this point here. So yeah, it's not triple digit returns, but prospectively, can it deliver steady double-digit returns? Well, nothing's guaranteed, and you make your own investment decisions. But prospectively, it it, uh, it feels like the sort of company where this kind of 20% performance seems um, not impossible, not impossible. So Japan psychologically is a nation of savers. They just are, and of course the businesses hold cash equivalent to 50% of GDP. Um, there's a couple of other things that we could say here that yeah, that they are sort of trying to change that cultural oddity. I suppose oddity is maybe not the right word, but you sort of understand that they are threatening to delist companies that don't treat their shareholders well. So, but this isn't tracking the topics or tracking the Tokyo Stock Exchange. It's working out and targeting companies where I suppose shareholder rewards are not there, but could be there or should be there. So it's yeah, very much a value basis approach. And in its past, it targeted companies like these. So Fanuc, for those of you that have watched my robotics, so they are these are sort of robotics companies. So these are now at sort of 30 times earnings, things like that. So they, as I say, they are going after the more value based today. So the high growth, exciting companies are not so much targeted. It's also the case that last Friday, so 2 days ago, I'm recording this on the 23rd of November, last Friday, that Japan announced a 104 billion pounds uh, stimulus package, so fiscal stimulus package, and a lot of this is essentially just gas, energy bills subsidy. So that's about £350 subsidy from your gas bill, electricity bill. So that is pretty substantial. And then we've got also tax cuts, 2.7 trillion tax cuts, and then we've got growth investments targeted at economic security, so artificial intelligence, semiconductors, shipbuilding, and defence. I've spelled defence wrong. Um, and they've announced that they're going to bring forward the 2% of GDP spend by the end of this year. So that's something that's happening very quickly. Uh, those 4 of the 10 are going to be beneficiaries of that stimulus. So shipbuilding, Kumagai, and then semiconductors at Nabtesco, Noritake, and Denso. Now, of course, yes, there are risks, as there always are with anything, and I would say the one of the risks is the currency has been depreciating quite a lot, um, to the point actually where it's gone from about 180 to 205. Just to give you an idea of what that means, in Big Mac meal terms, the Big Mac index being a good way to understand whether a currency is cheap or expensive, um, that you can buy one of those for 680 yen, and that is £3.31. So I think you can probably conclude from that that £3.31 for a Big Mac meal is flipping cheap. Um, that should be at least what, double that would be £6.62. I think £6.62 would still be cheap for a Big Mac meal today in Britain. I don't know how much they cost. I think they're about £7 or £8, and then uh, airports and places like that, it's more like £10, £11. So I don't know, but I'd say the currency is at least 50% undervalued. And of course, if it moves back to let's say 75 yen to a pound, well, this fund would more than double just in terms of GBP terms, because of the you'd essentially gain on the FX rate. Now, obviously, if it drops to, I don't know, 250 or 300, and a Big Mac meal costs £2, not £3, then yes, you'll also lose money. So it can work both ways. But I suppose you just got to think, like, would a Big Mac meal go down to just £2 or £1? I mean, how low can it go? Um, £3.31 seems insanely cheap to me. Um, and that's why tourism in Japan is such a big business, because it's incredibly cheap to go to Japan. And a lot of people are going to Japan to visit because of the exchange rate. It's also the case that, of course, the Japanese had challenges with the US and the Trump tariffs. That could resurface. Never say never. Obviously, there's a bit of a spat going on with China because the new prime minister said, "Oh, yes, if Taiwan was ever attacked, that would be an attack on Japan." So it's kind of that was a slightly controversial thing to say, and that has caused the Chinese to slap um, various measures against Japan. So I think they've banned seafood. They've discouraged their people from visiting Japan as tourists, and sort of measures like this. So there's kind of yeah, Japan's not without its challenges. It's also got a high level of debt. It's got demographic challenges, as in everybody is getting very old, and the birth rate is not high enough to replace. Um, so, Japan is not a trouble-free country, but everyone's got these challenges. I mean, demographics isn't just Japan, um, and also the situation that it now finds itself in is that it's so if we went to the news flow for Japan, that you'd see that Japan is actually inflation is a lot higher, but growth is a lot higher, confidence is a lot higher. In fact, let's see if we can get back to um, Japan news. So yeah, we'll talk about yields, bond yields in a moment. But yeah, inflation, well, is at 3%, so that's above where it should be. But food prices are now rising the least. The trade gap narrows sharply, so you can see there it went to 231 from 499. So exports are growing, imports are shrinking. Um, Exports grew 3.6%. Imports also rose. The PMI increased to 52. Manufacturing shrunk the least, so its PMI has risen to 48.8. Services is at 53. Um, and yeah, so there's a lot of good things happening in Japan. It's and obviously this big 21 trillion economic boost is massive. I mean, that is something like what, 3 times larger than what Rachel Reeves did in the UK with her 40 billion tax and spend. Um, Mainly because the tax kind of had more of an effect than the spend, perhaps. But yeah, the other thing to say here, and let's talk about bonds. Sorry, yeah, bond yields. Now, there is something called the carry trade, where essentially you could borrow money in Japan and then sort of take it overseas and invest it into something else and earn a higher rate of interest. So if you could borrow at 0.1 and then lend at say 5%, well, you'd make 4.9% profit. Yeah, in simple terms, and that was called the carry trade. Now, because bond yields are increasing, okay, bond yields are increasing, that carry trade is kind of declining or even disappearing or even reversing. In other words, the person that went and lent the money at 4.99 is now having to withdraw it again and sort of pay back because these rates are increasing. Although I would point out and say, whilst yes, if we look at the Japanese 30-year, I mean, it is massively higher than it was a year ago. If we go to the 10-year, well, you can see it's at record levels over 10 years. That's true. That is true. But it's also true to say that if we went and bearing in mind this one is at 3.3, if we go and look at the US 30-year, 3.3 plays 4.7. So it's a lot higher elsewhere. Same for the UK. If we go and look at the UK 30-year, it's even worse. It's 5.37 versus 3.3. So the carry trade is diminished, but the carry trade is not. I don't see that there is that. There is still a differential. It's more that international rates are increasing. Now, of course, yes, it does mean that the Japanese, which do have a large deficit, are now paying more interest than they were before. That is true, but I think it's also true to say that that it doesn't necessarily spell disaster. I think you've got to look at it in a broader context, and maybe it means that we will see a bout of inflation, that we will see more money printing and quantitative easing. Um, there's different voices and different opinions on this, and yeah, the inflation genie has kind of been put back into its bottle to a quite an extent, but you know regardless, I mean, yes, you've got to sort of say there could be some risks around geopolitics and around China, around the FX rate and different things. So none of these things are risk free. Um, but at the same time, I think, um, yeah, for me, it feels like a way of investing money into something that's akin to patient capital, boring businesses that are making stuff that, if we sort of look at some of the holdings, making stuff like gaskets for engines and catalytic converter casings and heat insulators for engines. It's all sort of very um, mundane, I suppose you might say, stuff, but it's stuff that is growing. It's people want more and more of it, and you can buy it cheap. Is the fundamental point. So it's yeah, and I suppose it's also the case that there are a lot of people piling into the Japanese market. So I mean, yes, you could go and invest and buy Japanese stocks one by one individually, um, or you can go in via a fund or via an ETF or via an investment trust. Now, I mean, they've all got merits and demerits. I suppose on one hand, you don't get like a discount to the as you would with an investment trust. Um, that's a negative, but I think the advantage of a fund, and particularly that this one doesn't come as an investment trust, so you've got the choice of, you know, something different to this or this. I suppose the advantage of this is that you also don't have to worry about the spread. So your buy and sell price are pretty much the same, and you don't have to pay stamp duty tax. So there's sort of horses for courses, I suppose you could say. Anyway, let's move on into the top 10. So as you can see, some very, very favorable metrics. So Kumagai, Gumi, is a construction firm. So they basically make civil engineering, building construction, real estate. They are welcoming the improving sentiment in Japan and see improved liquidity in the market and have delivered some spectacular um, growth. So the share price has gone up 47% in the past year. It's gone up 172% over 3 years. And although dropped in the last week, it's doing various projects around urban renewal, around the Olympics legacy. So it's kind of a quite a high profile business. Its earnings are growing. Its profits are also growing. So you can see here attributable profit up 841%. So it's pretty impressive stuff. It's excuse me, it's dividends, so it paid, as you can see here, 2.1, and that's a growing dividend number. So mega projects, international expansion, lots and lots of positive, strong buys from five analysts, and this 100 trillion infrastructure spend will favour Kumagai, perhaps through military spend or other things. Nichias is the second one, so that was the one I just showed you on screen with the gasket, sealing, insulation products. Um, they do a lot with something called high performance fluoropolymer (PTFE) products. And as you can see there, it's sort of for thermal slash acoustic insulation. So it's one of these sort of boring under the radar moat stocks that is extremely good at what it does. So a world leader. It does a lot of stuff with mission critical applications. So equipment for LNG plants and for hydrogen related equipment. So it's in the sort of sweet spot of kind of having a near monopoly in some of its products, and it's a 75-year-old product. It's part owned by its founding family, nearly at trading at book value, which is incredible when you consider it's a world leader. And how is it that these companies are at these prices? It's very, very surprising. And when they are guiding for growth in double digits, um, that and expanding into different countries. Lots to like about that particular idea. The next one is Pilar Corporation. So again, you can sort of see this is another gaskets company, but also sealants and seals, and as in seals like a gasket, um, but a lot around water and sewerage. So it's again a century-old specialist fluid control sealing technologies, mechanical seals, and yeah, again, a company that's investing a lot into research and development, this time into fluoropolymers, custom engineered seals for high pressure applications, and has net cash equivalent to 20% of its market cap, and trading at just zero point 0.8 times. It's just incredibly cheap for what it is, what it does. So very, very interesting um, metrics. There's so from what I've seen so far for the picks from this fund, they look good. They like it. Would I buy those if I were just buying single stocks? Yeah, I'd certainly. They'd be on my radar. They'd be the sort of stocks where I'd say, well, gosh, these are very undervalued. So I suppose to conclude, as I say, I mean, you make your own investment decisions on these things, but I see the fact that they are um, targeting companies that have a lot of stability, a lot of value, that are trading at very low valuations relative to and with a surprising amount of growth behind them. Considering this is a value focus, you kind of would expect to have to compromise on the growth, but it certainly for the ones I've looked at, that's not necessarily the case. The increase in shareholder funds, obviously it's an accumulation fund, but that will feed back through into the fund as increase in shareholder returns continue to grow and re-rate, and but also just corporate takeovers as well is the other thing that a lot of private equity are sniffing around Japanese companies. So if they are uh, um, holding companies that then get bought out, they'll typically get bought out at what, 30% plus premium to their share price in order to secure them. So again, lots of reasons to consider there to be uh, a long-term story going on around the I suppose the psychological hoarding of cash, and just turning that now into a different emphasis of shareholder returns and getting that cash back to shareholders through various um, shareholder rewards. So yeah, that sort of concludes this video. Hope that's been useful for you, and um, look out for the article that will be published in the next couple of days on my Substack. So that's all from me. Cheerio for now. Cheerio.